Welcome to the Daily Fortune, where we talk about the latest topics about finance and investment. But before that, please don't forget to click the like button, subscribe, and hit the notification bell so you'll know when we upload a new video. Now let's get started. We will again be talking about the greatest investor of all time, Warren Buffett. Warren Buffett can be our go-to person, and we will learn a lot from him about investing. What most people like about him is that he explains things in basic, understandable language so that everyone may learn. In this video, we'll talk about Warren Buffett's interview from 1995 that will teach you some very basic principles about stock selecting, investing, and general investing. According to Buffett, the first rule of investing is to never lose. And the second rule is to never forget the first rule, and that's all. So if you buy items for a fraction of their true value and buy a bunch of them, you practically don't lose money. Buffett shared that the most important quality for an investment manager is having a temperamental characteristic. It's the temperamental quality, not the intellectual one. In this business, you don't need high IQ. Instead, what you need is a stable personality. You'll need a temperament that enjoys neither being in the crowd or being in opposition to it. Because this isn't a polling business, it's a thinking business. You're not right or wrong because 1,000 people agree with you. And you're not right or wrong because 1,000 people disagree with you, says Ben Graham. You're right because the facts in your reasoning are right.
Short focus is not conducive to long profits. And here I can just focus on what businesses are worth. And I don't need to be in Washington to figure out what the Washington Post newspaper is worth, and I don't need to be in New York to figure out what some other company is worth. It's an intellectual process. And the less static there is in that intellectual process, really the better off you are.
What is the intellectual process?
The intellectual process is defining your level, defining your area of competence in valuing businesses, and then within that area of competence, finding whatever sells at the cheapest price in relation to value. And there are all kinds of things I'm not competent to value. But there are a few that I am competent to value.
Have you ever bought a technology company?
No, I really haven't.
In 30 years of investing, not one?
I haven't understood any of them.
So you haven't ever owned, for example, IBM?
Never owned IBM. Marvelous company. I mean, a sensational company, but I haven't owned IBM.
And so here is this technological revolution going on, and you're not going to be a participant.
Gone right past me.
Is that all right with you?
It's okay with me. I don't have to make money in every game. I mean, I don't know what cocoa beans are going to do.
When Buffett was asked about what he does that sets him apart from the 90% of other managers on the market, he answered that most professional investors concentrate on what the stock is expected to do in the coming year, employing a variety of arcane strategies, but they do not consider themselves to own a business. Whether you're investing for value or not depends on whether you care if the stock market is open tomorrow. If you're making a good investment in security, it shouldn't matter whether the stock market is shut down for 5 years. For Buffett, prices don't tell him anything about a business. The business figures alone tell him something about the company, but the stock price tells him nothing about the company. So he'd rather value a stock or a business without knowing the price initially. He's not easily influenced by the price in determining his valuation, and then he looks at the price after to see if it's out of line with what he thinks it's worth.
There are all kinds of things I don't know about, and that may be too bad, but why should I know all about them? I haven't worked that hard on them. In the securities business, you literally every day have thousands of the major American corporations offered to you at a price that changes daily. And you don't have to make any decisions. You have to make, nothing is forced upon you. So there are no called strikes in the business. The pitcher just stands there and throws balls at you. And if you're playing real baseball and it's between the knees and the shoulders, you either swing or you get a strike called on you. If you get too many called on you, you're out. In the securities business, you sit there and they throw U.S. Steel at 25 and they throw General Motors at 68, and you don't have to swing at any of them. They may be wonderful pitches to swing at, but if you don't know enough, you don't have to swing. And you can sit there and watch thousands of pitches, and finally you get one right there where you want it, something that you understand, and then you swing. And
so you might not swing for 6 months.
You might not swing for 2 years.
Isn't that boring?
It would bore most people, and certainly boredom is a problem with most professional money managers. If they try to sit out an inning or two, not only do they get somewhat antsy, but their clients are start yelling, "Swing, you bum," from the stands, and that's very tough for people to do.
So Buffett chose to stay in Omaha, Nebraska. It's described as a nice town, but nobody claims it's a world financial center. Buffett was asked another question about if he found his place or his home, Omaha, a little bit off the beaten track for the investment world. He answered right away that they get emails there and periodicals and all the facts they need to make decisions. That unlike on Wall Street, Buffett didn't have 50 people coming up and whispering to them that they should do this or do that in the afternoon. Buffett liked the lack of stimulation there, that they get facts and not a simulation. He'd probably be a lot worse if he was on Wall Street, since you become overstimulated there. Your focus could shorten because you're hearing a lot of things, and a short focus is not conducive to long profits. And Buffett can concentrate solely on the value of businesses in Omaha.
Warren, your approach seems so simple. Why doesn't everybody do it?
Well, I think partly because it is so simple. That the academics, for example, focus on all kinds of variables. Partly because
by academics you mean professors of
right,
finance?
The data's there.
In business school?
Sure, and the data's there. So they focus on whether if you buy stocks on Tuesday and sell them on Friday, you're better off, or if you buy them in election years and sell them in other years, you're better off, or if you buy small companies. There are all these variables because the data are there, and they've learned how to manipulate data. And as a friend of mine says, to a man with a hammer, everything looks like a nail. And once you have these skills, you just are dying to utilize them in some way, but they aren't important. If I were being asked to participate in a business opportunity, would it make any difference to me whether I bought it on a Tuesday or a Saturday or an election year or something? It's not what a businessman thinks about in buying businesses. So why think about it when buying stocks? Because stocks are just pieces of businesses.
Warren Buffett also stated that he didn't invest in companies he didn't understand, when asked why he didn't invest in technology stock. Buffett's methods seem to be so simple, but why is no one using them? Oh well, as for Buffett, he thinks it's partly because it's so simple that academics, for example, focus on all kinds of variables. The data is in business school, so they focus on whether you're better off buying stocks on Tuesday and selling them on Friday in election years and selling them in other years. You're better off if you buy a small company. Because the data is available, all these variables can be used, so they've learned to manipulate the data. And that's it, a short summary of Warren Buffett's interview last 1995. What I really like about Warren Buffett is that he makes everything so simple. He's not a Wall Street analyst who says, well, if we look at this technical indicator over here, the stock price is up 0.1% over the last day and a half. No, he's a long-term investor who speaks his mind because he understands that compound interest, and only businesses are an incredible mix if you invest wisely over time. I hope everything he shared will guide you in becoming a better investor and achieving higher long-term results. Thank you for watching. So that's it for today. I hope you learned something from today's video, and to get updated with the next videos, don't forget to hit the notification bell. See you next time.